it's very clear inflation is the #1 issue. You know, you've said to me 70-30 is the new 60-40 for a long time, that the 60-40 stock bond split is going away because it's just not going to work. We've had bond people, stock people used to a bull market for the last 12 or 13 years. What's the conference going to tell all these RIAs to say to their clients about their bond funds?
Well, that's the key. And it's important to remember, Bob, advisors are managing money for people who have real money. And if they're close to retirement or in retirement, having that balanced portfolio has always been important. But after 30 years of declining rates and now seeing rising rates again, there's a big conundrum going on. They're not as concerned about volatility in the stock market. In fact, numbers show they continue to buy on the dips. But as you point out, inflation and rising interest rates is a real worry. And the last time we saw this was in the late 70s when you and I were running around on our Stingrays, right?
Yeah, thank you for bringing that up. Hold on, I'm getting flashbacks. So what alarms me, I can't help but think it's alarming the investment advisors here, is the bond ETFs are all at new lows. I looked at it this morning. The biggest one out there, Vanguard Total Bond, new low. PIMCO's Active Bond, BOND, new lows. The iShares, the investment grade corporate, the Muni Bond ETFs, new lows. What's the alternative? If you've gone to 70-30 is the new 60-40, what's the 30?
Well, a lot of advisors and investors are taking their marbles and going home. There's more money that's gone in commodity ETFs year to date that have gone into U.S. fixed income ETFs year to date. There's $5 trillion that are in money market funds. There's $15 trillion in bank passbook accounts. People and advisors especially, and they're telling us this, would rather keep it safe or very, very low duration. So there's a lot of fear out there in fixed income.
You anticipate, what you're sounding like you're telling me is we're anticipating new outflows into bond funds this year.
It's more about diversification, dividend-oriented strategies, commodities, other alternative income strategies like some of these options overlay strategies that are out there that are really important. You're seeing flows go into all these areas.
Yeah. You know, like I've been saying, the advisors are used to seeing bond funds and stock funds go up for more than a decade. I'm really curious to see how they're going to sort of thread this needle. Do you think it's all going to be, let's just go into cash at this point, or let's just stay in the bond, into commodity funds?
Well, what you're hitting on, Bob, is today, there's more money in motion than we've seen in 10 years in the ETF space. That's why a lot of advisors are excited to be here, because we're going to tackle those tough questions. We're going to have a lot of strategies from really important people, but most importantly, advisors are going to have a chance to get together one-on-one for the first time in a couple of years.
Now, I want to just, before I get to our next guest here, a lot of new people coming into the business. Neuberger Berman's coming in. Morgan Stanley. My heavens, Morgan Stanley has discovered the ETF business. Don't let this get out. They're on the cutting edge of all this.
Yep.
I'm kidding, folks.
Capital Group?
Capital Group is already in. We've talked to them already. Money keeps coming in and people keep changing. I'm impressed by the fact that Morgan Stanley's getting in, but a lot of active managers are converting.
Well, it's all about choice. They're asking their clients, advisors, what do they want? It's not as though they're abandoning their funds, but they'd also like the choice of ETFs too, and that's what's key and critical.